All right, man. Profit guy, y'all know what it is. Hey, I'm back again with another trade breakdown. All right. Now, in today's video, um, is no different from everything that we've been studying in the past. All right. Again, you guys know I've been trading these concepts for a very, very long time. And I just want to reiterate some of the things that we already have studied in the past. All right. It's always rinse and repeat with my trade breakdown videos. I'm just hammering on the same concepts that I've talked about in the past before. Now, in this particular video, I'll be covering Euro USD. I'll be covering GBP USD as well. Maybe if we have time, if I'm not willing to make the video too lengthy, I'll be looking at Bitcoin too as well. So there's going to be a lot to uncover in today's video. I really, really hope that you guys gain value from the video. I really hope that you have your pen and pads and you're taking notes and you're, back testing these concepts as well, because I'm not really trying to make you trade the way I trade. I'm not really trying to like force my school of thoughts to be hammered down your throat, but I want to make you see how you can apply several different strategies and use that to formulate one strategy that you now trade with. Now, I don't want to say I'm trading, smart money concept, or I don't want to say I'm trading um what some people would say is retail concepts. However, at the end of the day, we are all retail traders, but for lack of better words, just to separate different strategies, or maybe I could say some people are trading more so institutionally because they feel like they're trading like the bank, or they think they're trading like the banks, when in reality, that's not the way the banks trade. No, I mean, I don't work in the bank, so I don't think I would know how a bank trades, right? But my approach to trading has always been a structural approach. And I'm going to be demonstrating my understanding of market structure in this particular video with you guys. But now there is a very, very interesting tool that I'm going to be pulling out, which is the Fibonacci tool. And I'm going to be showing you guys as well how to correctly apply the Fibonacci tool. And now, correctly is a very strong word. I don't want to be saying correctly like, you've all been using the Fibonacci wrongly, but I just want to show you how I apply the Fibonacci. I feel like, yeah, maybe that's a better thing to say. I don't want to come here and say, you've been doing things wrongly, or you have, a wrong way of looking at the market, because the foreign exchange market or the financial marketplace is somewhere where people can have different perspectives and can still be correct. They can still be absolutely right. So there's no real right or wrong way of looking at the market, but there's just different applications of different concepts. Now, I know I've been talking too much, and of course, you guys want to dig into the markets with me. So yeah, let's jump into the market right now. Let's jump into the charts right now. So the trades that I'm going to be breaking down are this area right here. So I'll be picking my highlighter tool. I'm not just showing you guys. I'm not just doing like a trade breakdown. I'm also showing you guys some tools and how to also utilize these tools as well. So I'm going to be picking my highlighter tool just because I want to show you guys the area of the market where we are actually going to be finding the trade that we're going to be breaking down. Now, I believe this trade was from the NFP. So this sell from that area all the way down, and then this buy from this area all the way up. And maybe we're going to be talking about this sell as well. If we have time. But basically, I want this to be a very wholesome video. I want you guys to take as much value from this video as possible, because I'm going to be digging into EURUSD right now. Of course, you guys know EURUSD is one of my most traded pairs. So in terms of how well I understand the movement of EURUSD, I can tell you for a fact that I understand the movement of EURUSD pretty well. All right. So this is a very, very simple trade. Just looking at the market here. This is why I say perspective is very, very important when looking at the market. Now, I'm going to be taking out this last area here, and then maybe I'm going to be changing the color of this. Sorry. Maybe I'm going to be changing the color of this to like a bright purple color. Yeah. And this as well. Let's change the color to a purple color. Yeah, because the other one looks very distracting. So these are the areas where we're going to be going into the lower time frame to find out how exactly the trade was presented to us on the lower time frame. But for now, let's understand, number one, perspective on the higher time frame. Let's understand number 2, context on the higher time frame, and let's understand number 3, narrative on the higher time frame. Now, for perspective, if you're looking at the market from a buyer's perspective, what do you see? You first of all want to see a clear trend. You want to see the market creating highs, higher lows, higher highs, higher lows, higher highs. As soon as you see this type of market structure, of course, with the characteristics of market structure, which I have talked about in several different videos in the past before, as soon as you see this type of formation in the market, then you know we are definitely in an uptrend, right? Now, once you can identify an uptrend, the next thing you want to do is you want to identify where the breaks of structure are in that uptrend. And what do I mean by break of structure? Whenever the market is creating a new higher high and then pulling back into a certain level and creating a new higher high, these are areas where you call your structure points. Now, if I pick my highlighter tool here once again, and I start to pick out my structure points, which are here and here, sorry, you have another structure point there, you have another structure point here and here, sorry, oh my God, here, here, and here, right? If we apply the same concept of that in looking for structure points within the leg from this low all the way to this high right there, what we're going to discover is that we're going to see something that looks like this. This area here is going to be a low. This area here is going to be a high. This area here is going to be a low. This area here is going to be a high. Why? Because we just took our structure to the upside around this area here. Now that high caused this low, and this low eventually caused this high, that low, that high, and so on and so forth. Now, I just want to make you guys understand that we are looking at a bullish market. Now, the next thing after you have indeed marked out your structure points is now you want to connect the dots. So it's now going to make a lot of sense that, okay, yes, I'm definitely looking at a bullish marketplace right now. So pick your path 2 and now connect the dots, okay? Pick your path 2 and of course connect the dots, right? Once you connect the dots, it's going to be so clear that, you know, you're going to have no doubt that you are, of course, in an uptrend, okay? You have no doubt whatsoever that we are in an uptrend. Now, of course, this is external structure. I've talked about internal and external structure extensively in the past before, and I'm also going to touch on internal and external structure even in this video, but basically this is going to be our external structure looking from the higher time frame that we are currently on right now. Now, a lot of people consider the 4-hour time frame to be a higher time frame. So if we are looking at structure, especially when we are more zoomed out, something like this, then we are looking at external structure, all right? But sometimes when we are zoomed into the market like this, we can be looking at internal structure. So again, just to reiterate that one, internal and external structure is kind of like when you're looking at the market from a zoomed in and or zoomed out, again, perspective. And again, when you're looking at the market on maybe a higher time frame versus a lower time frame, because the candlesticks on the higher time frame represent the higher time frame that you're currently on. For example, a single candlestick on the daily time frame represents a whole day's worth of data, whereas that same candlestick on the 4-hour time frame is going to give you a lot more candles because it's now broken down into, you know, different time frames. That's the unique relationship between the candlestick and the time frame. All right. Again, I said this is going to be a wholesome video and you can learn so much from this one video. So now the external structure of the market that I've drawn out here, I want to change the color of that to black because when we're looking at more so internal structure, then the color is going to be red. And you can see how internal and external structure are very, very much hand in hand. They go hand in hand, basically. All right. So let's change this to black, and that's going to mean for us the external structure of the market. Now, again, this is from somebody that's looking at the market from a buyer's perspective. Now, mind you, the trade that we want to break down, okay, the trade that we want to break down are these trades here, are these trades here, and this one right here. It means that at the particular point in time, all of this, okay, to this area of the market hasn't happened yet. All right. So keep that in mind. All right. I'm going to be breaking down the sell trade and the buy trade as well. Now, because the sell trade happened first, if you're going to be looking at the market from a seller's perspective now, this is where you now want to zoom into the market and now look for a clear downtrend. So just like you want to see a clear uptrend before you look for a buying opportunity, you want to see a clear downtrend before you look for a selling opportunity. Now, looking at the market from this perspective, from a seller's perspective right now, okay, if you pick your highlighter tool, let's now start to look for the breaks of structure to the downside. Now, following the trend, this is a high, this is a low. This is the last low that created the last high in the market, okay? Now, from this point on to all the way down here, we had a change of character and or a break of structure to the downside, all right? A change of character and or a break of structure to the downside. Now, because I've already used purple for all of the structure points, let's change this to, red. All right, let's change that to red now. That's going to be our hotspots where we're going to be breaking down the trades, okay? Now, my apologies if this video is going to be a long one, but I'm doing so many things in this particular one video that I'm just giving you a trade breakdown. Number one, I'm showing you how to gamify the experience of trading. Now, there's no way you will mark up your charts like this and you will miss trades. There's no way in the world. Now, looking from a seller's perspective now, what do we want to see in a bearish market for us to look for a sell? We want to see break of structure to the downside, break of structure to the downside consecutively, right? And if you look at the leg that we have from this high to this low, we can now see that that is a whole leg of price, okay? From this high all the way down to this low, that's a whole leg of price. But now within that leg, we can see some internal structure. So this is what we've come back to, internal and external structure, okay? For the selling side, looking at that leg, we can now see another layer of structure within that leg, even on the same time frame. So this is what I mean by zoom in and zoomed out perspective, whereby from this area of the chart, looking at the charts like this, I'm also zoomed out. So my leg of price is from this high here all the way down to this low here. But when I zoom in a little bit, I can definitely see another layer of internal structure within that leg. So now my internal structure is more so a zoomed in perspective of when I'm looking at the market, all right? So marking out the internal structure now, because it's very, very important for us to do that at this particular level from the higher time frame. Internal structure is going to be this, this, this. We had a low. That low created a high. We had this as a low. We had a high. And then we had that as our final low. Now, I'm going to be changing the color of that internal structure to red. Okay. Now you can see the two layers of market structure, both the external market structure and the internal market structure. Now, this is what I want you guys to understand. Okay. Let's go to the conceptual understanding of market structure before I jump into this. Now, I want you guys to understand that when the market is moving on the higher time frame, we have this, and then we have had a break of structure on the higher time frame. Now, according to the higher time frame, we are expecting the market to pull back into a certain level and sell off. This is what we are expecting on the higher time frame. It means that if we are going to get an order block on the higher time frame, we are expecting the market to pull back to a higher time frame order block, something that looks like this. But remember, the leg of price that broke structure on the higher time frame also has internal structure as well. So from this high to this low, right here, there must have been some type of internal structure within that leg. Now you're using the higher time frame order block in line with the internal structure. All right. Okay. So if there are areas whereby on the internal structure, imagine there's a break of structure here, and we have an internal order block around here, and that internal order block is aligned with the higher time frame order block, then that internal order block is an area where we should be looking to sell from, because there is an alignment with the higher time frame order block. All right. I really hope that makes sense, because ordinarily you just want the market to pull back into the higher time frame order block for you to sell off. And of course, you can't be selling from the entire higher time frame order block, because your risk to reward is going to be very, very little. And of course, your risk is going to be very, very large. All right. So you want to narrow down the higher time frame order block to a level whereby you can reduce your risk and increase your risk to reward. Okay. And most of the times when you plot your Fibonacci, okay, you're going to find that area at the 62 to 79% level. I don't know. It just works like magic. I don't know how it came to be. But basically, the Fibonacci tool is a statistical tool whereby in 100 times, basically, what this is saying is that 62 to 79% of the time is going to come back to this level that is now termed the golden ratio of the Fibonacci. And this is how everything ties together. Market structure, okay, internal and external market structure, and of course now Fibonacci. Now, if I wipe all of this, okay, let's go back into the market and let's see whether or not this theory is true. Okay, let's go back into the market and see whether or not this theory is true. Now, if you're looking from the buy side, okay, remember we started from the buy side, then we broke down the sell side. Now, if you're looking from the buy side, obviously on this leg of price, we don't really have a lot of visible internal structure, and that's the reason why I didn't mark out the internal structure there. But if you zoom in very, very closely, of course, you'll be able to see high, low, high, low, high, low inside there. But around this area, the market was heavily English no kima, man. The market was heavily bullish at that time, man. So there's really not a lot of visible internal structure within that leg, But if I mean to mark it out, then I can just do something like this. Let's say we have this as a low, let's say high. See, you can see it's not as clean as the internal structure we had on the selling leg. All right. Now, for every of these internal structure levels that there was a pullback and a break of structure to the upside, okay, we have valid order blocks, okay, just according to the law of structure. According to the law of structure, for example, here where we had a high, a low, and a break of structure on the internal structure of the market, we had an order block there. That's why whenever the market pulls back to this level, you can always find a reaction, okay? Whenever the market pulls back to these levels, you can always find a reaction. And these areas are where the retail guys would call a break and retest level. Okay, you can see how there's internal structure along that level. It's not just the fact that the market broke this and this level has now become a support level. It's not like break of support has turned into resistance. I'm using the internal structure of the market as well to show you that even on the internal structure of the market, there's confirmation that there might be a buy from that area. And of course, you can see what the reaction is. In fact, in this particular example, this area of internal structure on this buying leg is what caused the market to pull back into the selling area that gave this trade. Okay, and that's the trade breakdown right there. But again, let's plot our Fibonacci on the buy side. Let's plot our Fibonacci on the buy side and let's see where is the 62 to 79% level. So if we plot our Fibonacci on the buy side, you can see where the 62 to 79% level is. All right, the market reacted from the Fibonacci level. Okay, and this was this push to the upside here, okay, was how this trade came to be. Now, I've said it several times that if the market is going to sell, the market must buy before it sells. And if the market is going to buy, the market must sell before it buys. Now, looking at this market right now, of course, if you look at the sell side from a seller's perspective, there was a break of structure to the downside around here. Okay, so let's annotate break of structure to the downside, or some people are more comfortable calling this a change of character. Okay, whether you call it break of structure or change of character, we're talking about the exact same thing. But just to differentiate between the two, a change of character is more so like the first break of structure to the downside. Why is it called a change of character? Because it is the character of an uptrend to keep making higher highs and higher lows. Okay, now a change of character is going to be the first break of structure to the downside. Now this is simply a break of structure to the downside, but since it's not a character of an uptrend to break structure to the downside, we can now call this a change of character, because the character of an uptrend is to keep creating what higher highs, which of course we're going to have a break of structure to the upside to create a higher high. Now if we break structure to the downside, that is a change of character. But a change of character is not an indication that the market has reversed. It's an indication that the market may want to or could reverse. It's only when we have follow through break of structure to the downside that has now established a trend. All right, multiple break of structure to the downside establishes a trend. That's when we can now be selling the market, with the certainty of the fact that the market has now reversed. All right. So again, I'm going over multiple things in this video, right? So this is a break of structure or a change of character. So that's the one leg that pushed price down. Again, for the market to buy, okay, for this trade to even be possible, the market had to react from something, okay, that would push it to the upside for it to buy. And look at where the market reacted to. This area of price that was broken as resistance and turn to support. So this is like for retail traders, this is like a break and retest type of trade whereby, you know, their entries will probably be around somewhere here. So their entry will be around somewhere there. Maybe their stop loss in line with the Fibonacci level now can be below the 79% level. And if they're looking for like a 1:2, you can see the markets almost delivered a 1:2. This is an amazing trade for retail traders. And again, it proves that, you know, break and retest work. Okay. But again, if you understand very, very well market structure as a quote unquote retail trader, right, then maybe your stop loss might have been a lot smaller around here, whereas in this case your stop loss would have been hit, but maybe your stop loss could have been a lot smaller and your risk to reward would have been a lot more healthier. Okay, this is on EURUSD, a 30 pip stop loss, which is not bad for like an average stop loss for you to have on a pair like EURUSD. So if you're a retail trader trading break and retest and you understand market structure very well, knowing well that this area here may be an area of resistance that has been broken and turned into support, if you can identify the internal structure along that leg while the market was taking out this area, and you can, you know, identify the more so refined area of price and use an average you know, stop loss of 30 pips, then you can get a 1:3 trade like this. But this is not the trade we're breaking down. Again, we're not even breaking down retail concepts here. I'm just trying to show you how you can blend retail, okay, quote unquote retail, and quote unquote smart money. All right. Yeah, but again, let's look at the selling side. Okay, please, I hope we are not lost. Okay, I hope we are not lost. We're looking at the leg of price from this high to this low. We have gotten the internal structure of that leg, and as I said, whenever we have internal break of structure, so let me start marking all of the internal break of structures. So around here we had a break of structure, and that was an internal break of structure. So I'm going to say INT, IMBOS, internal break of structure. Okay, that's internal break of structure. So whenever we have an internal break of structure, just by the rule of structure alone, just by the law of structure alone, we are definitely going to have order blocks, all right, or valid order blocks, just according to the rule of structure. Okay, just according to the rule of structure. Whenever a higher low area or a lower high area causes a lower low or a higher high, then we're going to have valid order blocks, because if the market retraces back into those levels, where is it going to trade from? Of course, the order blocks. All right. So all of these levels are internal break of structure levels. Now, how do you utilize the Fibonacci? First of all, you know that whenever you're looking to sell the market, you only want to sell from the premium area. Okay, whenever you're looking to buy in the Fibonacci, you only want to buy from discount, you only want to sell from premium. All right, now plotting out the Fibonacci for the sell side, let me remove the buy Fibonacci. Plotting out the Fibonacci for the sell side, you can see the area of the charts where the Fibonacci ended there for that trade. Okay, again, the 62 to 79% area. But again, we're not just using the Fibonacci levels, because if we're only going to be using the Fibonacci levels, then our entry is going to be a lot earlier. Okay, your entry is going to be a lot earlier, right? This is going to be your entry, and of course your stop loss is going to be a lot larger. Okay, obviously to take out this structure point here, you can see you have a 1:2.6 risk to reward trade. Not that this is a bad idea, but I mean, of course, you can do a lot better in terms of refining the areas where you want to enter the market from. So just by the Fibonacci alone on the seller side, you can see that again, we find ourselves in that golden ratio of the Fibonacci, which is, you know, the 0.62% level to the 0.79% level. All right, but that's not the only thing we're using. We're not just using the Fibonacci as our, you know, holy grail. Okay, we want to look at again another level of internal structure. Now we have all been doing this analysis on the 4-hour time frame, which is a higher time frame. Now we have gotten specific levels where we want to trade from. All right, so you can see this order block here, this breaker level here. Now I'm going to explain the breaker level. before I jump into the lower time frame. Now, the breaker level is simple. Whenever there has been a break of structure to either the upside or the downside, in terms of possibilities, there are two possible levels whereby the market can come. We have seen how there was a break and retest for this buy. It's the same thing that can happen in that same manner in the selling side. So if this actually happens, which is like a break and retest of that level, the market is retesting the breaker level. So on the internal structure of the market, all right, on the internal structure of the market, we have valid order blocks and we have valid breaker levels, and all of this is on the higher time frame. So again, please don't get confused. This is higher time frame internal structure and higher time frame breaker level, regardless of whether it's coming from the internal structure on the higher time frame or the external structure on the higher time frame. As long as it's on the higher time frame, you want to treat it like an important level, whether it's higher time frame internal break of structure breaker level. Okay, I really hope this makes sense, man. I know I'm going through a lot of garbage here, okay, but I really hope this makes sense. Again, on the higher time frame, it is internal structure and internal breaker, but because it's on the higher time frame, you have to treat it as though it's very, very important. Okay, you're not just going to throw it away because it's internal structure on the higher time frame. No, as long as it's on the higher time frame, it's important. All right, I believe that came out a lot better when I said it just now. Okay, yeah, so now we can now go to the 1 hour time frame. And since we are looking at the selling side of the market, let's now look for another layer of internal structure. Now, look at the market around here. When this internal structure break happened, the leg of price that you'll be interested in is the leg from this high to this low. All right. So I just want to look for the internal structure of that market because that is where aligns with, again, the higher time frame internal market structure breaker. Okay, the higher time frame internal market structure area or breaker level. All right, so if I'm going to do that, then my internal structure here is going to be from this high, we had this low, we had something like a high there, we had this low around here, we had this high, and then we had that low right there. So I'm going to change the color of this to orange just to make you understand that that is another level of market structure. That's another layer of market structure. Now, I've been able to streamline the area I want to trade from to just that level. Okay, to just that orange area there, to just this orange area here. Because now looking at this, remember I said whenever there's an internal structure break, there is a valid order block there. Now, on that 1 hour time frame, again, we are seeing alignment with the higher time frame breaker around here. Okay, so this one was very simple. That 1 hour, area there, that was where the trade came from. So if I remove this, you can see after narrowing down the market to that area there, again, we had another layer of internal structure break. Okay, another layer of internal market structure break. Just right there. Just right here, you can see there was another break of structure in there. So you can see on the 1 hour time frame, we had an order block there. On the 4 hour time frame, what do we have there that tells us to sell the market from there? On the 4 hour time frame, we have a higher time frame internal breaker level. And on the daily time frame, okay, on the daily time frame, what do we have there? We have a daily order block. So the daily was telling us to sell from there. The 4 hour was telling us to sell from there. And the 1 hour was telling us to sell from there. Now, where is the place where if you put your entry, you're going to have the best risk to reward ratio? Definitely on the 1 hour time frame, because having narrowed down the market to that area there, if you check your risk to reward on that trade, okay, we check your risk to reward on that trade, that's now, you can get away with a 15 pips stop loss, or let's say average stop loss of 20 pips. Now, this is one thing that a lot of smart money traders suffer from. They don't want to inflate their stop losses to put it at a safe area. All right, it's very, very okay for you to use a 20 pip stop loss in this type of trade, because you can see that's for a very, very amazing 1:5 risk to reward trade. Sometimes when you try to over tighten your stop loss, the market can just kick you out, especially when on this particular day, it was a fundamental driven move. That was the NFP move. You can see how the market spiked up exactly to that area there. And of course, the market spiked down. Now, how can you catch more trades on this leg? Just go to a lower time frame, such as the 15 minutes time frame. And, as soon as the market reacts from there, just start to follow market structure again. All right. Just start to follow market structure again as soon as the market, all right, as soon as the market breaks to the downside. If you look what happened here, you can see that there is, again, a break of structure to the downside here. I know my charts are looking very messy right now. There's a break of structure to the downside here. If you're going to mark an order block, definitely your order block is going to be, I got that from the 1 minute time frame, but your order block is going to be on this candle. So you can see how the market basically came back here and sold. But I mean, look at the price action on the 1 hour time frame. I believe even if you don't go lower than the 1 hour time frame, there's more than enough that you can see on the 1 hour time frame to make you understand these concepts. All right. Now that's for the selling side. Okay. Now just take a minute to, pause the video and just look at the, price delivery in terms of the market structure. Of course, when you have your valid levels all marked out, seeing liquidity is going to be something that's going to be very, very easy for you. You don't have to start chasing liquidity in the market. You don't have to actively be looking for liquidity. Okay. Yes, liquidity is the fuel of the market. Once the market grabs liquidity, the market is going to tank in the other direction. But however, you don't want to start your analysis by looking for liquidity. The first thing you want to find is a clear trend. The first thing you want to look for is a clear trend. All right. Now that's for the selling side. Now for the buying side, again, the same story is the case. Okay, the same story is the case. Now, for the buying side on the 4 hour time frame here, we have had 4 hour external structure with the black line, 4 hour internal structure with the red line. If we go to the 1 hour time frame, we can see again another layer of internal structure. Okay, another layer of internal structure on the 1 hour time frame. Now, if you zoom into this, now when did this structure break? You would agree with me that it was from this low around here to this high around there. Okay, so I want to look for the third layer of internal structure within just this push. All right, now picking my path tool, and sometimes you want to stretch out the market like this. You want to stretch out the market like that. Then pick your path tool and now start to draw out the path of structure. So we have a high, we have a low, there's a break of structure here, that's a high, this here is a low, that is a high, this is a low, that's a high, this is a low, and that's the high right there. Okay, so this is my third layer of structure, and you can see why this area here is an order block. Now let's go back to the daily time frame. Let's see if the daily time frame is telling us to buy from that area as well. Now, I know this may seem a little bit confusing for somebody who doesn't have prior experience of all of these things, but again, you just want to go back and study. Now, on the daily time frame, you can see we have a daily order block. Okay, remember I said the market will always reach back to the higher time frame order block. All right, now the market is reaching back to the daily order block. Okay, on the 4 hour time frame. According to the 4 hour market structure, the market is also reaching back to a 4 hour order block. You can see it right here. So the daily and the 4 hour have aligned. They are both telling us to be looking for buys from that particular area. All right. And now on the 1 hour time frame, you can see again, the 1 hour time frame as per structure is telling us that this area is an important area where we should be looking to buy the market. And this one was very simple. I'm not even going to show you guys the lower time frame confirmation that led to a massive, very, very high risk to reward trade here. I'm just going to be showing you on the 1 hour time frame alone. Okay, just put in your entry right there. So you can see this is on average 30 pip stop loss trade. And you can see how this delivered a very, very nice That's a 1:2, 1:3 risk to reward trade. Okay. Very, very amazing trade right there. So that's the buy and the sell on EURUSD. I really hope that makes a lot of sense. I really hope that makes a lot of sense. I don't want to go to super low time frames, just not to overcomplicate things for most of the people that are going to be watching this video. But yeah, I believe all of that is going to make sense when you take out the time to watch this video and take out the time to understand the things I'm going over in this particular video. All right. Now let's take a look at GBPUSD. The story is exactly the same. The story is exactly the same. All right. The story is exactly the same. Going to the daily time frame on GBPUSD, if you have a bias perspective, you can see you want to be playing off of like the break and retest, okay? The break and retest. When in reality, this area here is, an area of resistance that has been broken and now turned into support. That's what retail traders are seeing, okay? But smart money traders want to look within this area here. If there are internal structure levels that align, okay? If there are internal structure demand levels that align with this external structure breaker level. I hope that makes sense. All right. Now going to the 4-hour time frame, you can see we have internal structure levels. Okay, you can see that's that same area on the daily, but now on the 4-hour we have some internal structure levels around there. And how do we know these are internal structure levels? Because we can see a clear trend. Okay, we can see a clear trend. So this was a high, that was a low, this was a high, that was a low, this was a high, that was a low, and that was a high. Okay, so it makes this here is an order block, this here is an order block. All right, on the 4-hour time frame. And you can see what happened here. The market bounced off of this order block. Now for this one, you might want to wait for a confirmation before you enter the trade. And where do you want to find your confirmation? Something like the 1-hour time frame. You want to see confirmation of a trend. Now what is the confirmation of a trend? You can see here you have, after the market reacted from that area there, this would be your low, this will be your high, that will be a low, that will be a high, meaning there is a break of structure to the upside here. Okay, and there is an order block here where your buy trade would now exist. Okay, so your buy would come from this area here. All right, you buy from there. Your stop loss can be something like that. That's a 12 pip stop loss. Now, on average, if you're doing like a 20 pip stop loss, because somebody would say, why did I mark out this zone? That is from the 15-minute time frame. Okay, that's from the 15-minute time frame. You can see there's still another area of price that the market could have actually come to. I'm sweeping all of this as liquidity. But if your average number of stop pips for your stop loss is 20 pip stop loss, then you can definitely scale through with that type of trade. And guys, bro, you can still have a very decent risk to reward with 20 pip stop loss targeting that liquidity. Of course, you can see that's a 1:5 risk to reward trade. All right, that's a 1:5 risk to reward trade, and that's an amazing trade for a day trade. All of this happened in one single day. All right, and that's a very, very amazing risk to reward trade, and that's for the buying side. Now your assignment is for you to figure out what happened on the selling side. Now, of course, I'm not going to come here and give you everything. This video is already long enough. I've been timing myself, and you can see what the time is, 49 minutes. Most people are not even going to make it this far in the video, but hey, don't shoot the messenger. All right, all you can do is go back to the charts, try to practice these things, try to look for these concepts on your own. All right, try to look for these concepts on your own, try to backtest until you yourself are convinced that you not only can identify these things, but you can apply them, and of course you can execute on them, and that's going to make you money in the financial markets. Of course, it's Profit Gang, man. You already know what it is. Up until next time, I'll see you in another video, man. It's gang gang.